Hey everybody, Economic Ninja here. I hope you're doing great. We're going to be talking about what I went through as my real estate investment career started in the early 2000s. Actually, it was around the year 2000, and me selling my homes right about here, liquidating all of my portfolio except for 3 properties, and then what happened in the subsequent years and why I can tell you that home prices are going to be coming down. It's so crazy. If you only knew how close this camera was so that you guys can see this stuff. So what we're going to do is we're going to dive right in, and I'm going to go through the different colors of this, and we're going to start with, well, let's do this. All of this entire thing hinges on employment. Employment is the #1 driver of a real estate market. I know it sounds crazy because you'd think that, oh no, it's interest rates. Oh no, it's home prices. Oh no, it's insurance. No, it's actually not. It's all about how many people can buy your product. How many people could actually buy the house. Now, employment figures have been skewed extremely over the last handful of years. Type 1 if you agree. And one of those being that this metric that I'm using right here is the employment population ratio, the employment to population ratio from ages 25 to 54. Now, there's so many different employment metrics, one of them being full-time, one of them being part-time. And we are seeing an explosion in part-time in jobs. And we're seeing a drop-off of full-time employment, right? Now, one thing that people need to realize too is full-time employment brings one thing that usually part-time does not bring: insurance benefits, and a second thing, retirement benefits. So the ability to put into 401ks and things like that. So you have less of a wealth effect when your citizens of your country are more on the side of part-time as opposed to full-time, okay? They have less of a wealth effect because they have less money going into savings. They have to come up with their own insurance benefits and things like that. And it also becomes harder on the government to supply them some type of medical care in case they have emergencies, things like that. So you have to consider that. Employment to me is #1, all right? Now, if you notice real quick here, in employment, this metric right here, the ratio of employed people to the population was steadily picking up in the early 2000s, where it peaked over here in 2007, a little drop, and then it peaked again, a smaller peak, and then it fell off a cliff starting in 2008. And then this was in January 2008. Now let me explain also, these black lines represent recessions. We had a short recession in 2002 coming out of the dot-com bust. Companies were coming out with horrible earnings because there was less of what? A wealth effect from the run-up of the dot-com boom, okay? So there was less money in the stock market, there's less money in people's 401ks, retirement accounts, so they had less money to go out and spend in the real economy, or less of a wealth effect to go out and create more credit, okay? Now you notice here, you gotta love this, tiny, tiny little recession. Why? Because a ton of money was pumped in, and you can also see this drop in employment. Now, this drop in employment was very long, very steady until it bottomed out here in around about 2011 to 2012, and then it started taking off again. So employment is very important. And by the way, if you notice over here, we are actually in 2022, and all of these charts go to 2022. We're already seeing that dip, and I believe that dip is accelerating this way to the downside for employment, okay? So again, very important metric. So let's start with this, median, nominal earnings. These are people that are employed full-time, okay? That's the most important thing. I wanna look at that metric. If we have a whole country of people that are not employed full-time, well then they have what? Less benefits, less insurance and retirement, things like that. So I want the full package. That's what we wanna see. We wanna see people that are employed full-time. They've got gainful employment. So you could see everything here starts at the year 2000. Now coming through the recession of 2001, 2002, you see it sort of flatline. And then it starts to make a nice steady increase. Why is that? Because as home prices increase, as employment increases, so do the earnings, so do wages. Jobs become more competitive. Companies are trying to find better workers. They're raising their salaries. So right here in 2008, you see it flatline, right? At the same time, we're seeing all kinds of crazy stuff with interest rates and with home prices. And then we see it start to rise coming out of that recession, and we see it dip here in 2012. And the 2012 was a really interesting time because that's really when we saw real estate bottom. We saw a lot of key metrics bottom, like the employment numbers. So then you start chumming up higher up into 2018, and you have to realize what the Fed funds rate was. Now, I didn't put the Fed funds rate in here, and I'll probably do another video basing mortgage rates or comparing mortgage rates to the Fed funds rate, because it's a very important metric, and it follows it generally, not exactly. Now, in 2018, we saw this peak here, and in 2018, what a lot of people don't realize is from 2015, right here, to 2018, the Fed started raising, right? They started raising the Fed funds rate. And it wasn't until October of 2018, Donald Trump came out railing against the Fed, saying that they were trying to crash the markets, and indeed they were. The reason why the Federal Reserve is very intelligent. They know that with lower rates, more people are encouraged to go out and borrow money in excess and run up all kinds of different markets, capital markets, housing markets, all kinds of stuff, right? They were raising those rates, and they were trying to tighten, do some quantitative tightening and loosen up their balance sheet. They wanted to dump their assets. They didn't like those, right? Anytime the Fed's getting rid of stuff, it's because they know these are toxic assets. Because the only reason they're on the Fed's books is because banks knew they were toxic assets, and they had to get them off of their books to stay solvent. So in 2018, the Federal Reserve did an about face. It was the first time since John F. Kennedy that the seated president was railing against their policies, and they did an about face. So from 2015, 2018, they were raising rates. It was around Christmas Eve, I believe, of 2018 that they did an abrupt halt. Now, let me stop there real quick and say, if you want more information like this, I've got the coupon link for 80% off the real estate crash course. It's the last time. Sunday night will be the last time that is ever that price, that course, okay? It's the link's down below. So employment, you see, just sort of shudder, comes right across, and we're talking about the earnings. See what happens to me when I just get off track? Holy cow, squirrel. Earnings, just the amount people are getting paid, right? The average salary, just flatlined. Now you notice that it ticked up right up here. That's important, right? Because a lot of people are talking about that. Why? Well, companies are having to pay employees more just to stay. Now, what I want people to understand is this jump doesn't mean everybody's getting paid more. There are less jobs, full-time jobs, than there were way back when, right? Full-time jobs are starting to fall off a cliff, but those holding full-time jobs, that is increasing, but it's not increasing as much as inflation, okay? That's very important. So now, let's dive into the median sales price of houses. This is what everybody looks at, right? Ironically, they don't always look at the sales, they look at the sales price, but they don't look at how often they're selling, and they don't look at the velocity of homes. Right now, our country is reeling in sort of a weird kind of cycle. It's not weird because the exact same cycle happened right here in 2007. And that is, you look at your neighbor's house and it's down the street for sale, and they're asking a massive amount. And to you, you think it's as good as sold because 6 months ago, another neighbor sold their house for, let's say, $30,000 less, and it sold in a couple days, right? It was fast. So you're thinking in your mind, that's how much that house is going to go for that price, and you're also thinking that's what your house is worth. But there's a very big misconception there, and a wake-up call that's about to happen in the next, couple of quarters, okay? So we're going to start with, okay, median sales price of homes in the U.S. Now, this isn't bubble territory. This isn't Beverly Hills. It's not San Francisco. It's not Miami, all right? But something different this time because of that mass migration out of California and New York after COVID, which caused ballooning prices all over the country, and the invention of telework. All right, so you see the homes slightly cruising up here until 2001 in this recession, and they dipped down. They came up, they're tracking up real nicely, and then they stopped. They peaked right here in 2007. It was like around January 2007. Now, to tell this story right, we have to immediately correlate it with 30-year fixed mortgage rates. This is very important, okay? Because when you combine a mortgage rate and a home price, you come up with a certain amount per month, right? And then you also have to track, how much wages are they strong, how's unemployment, and all that kind of stuff. So in 2000, this right here, the average 30-year fixed mortgage rates, these are conforming government conforming FHA, Fannie, Freddie rates. We peaked at 8% right here, mid-2000. We came tracking down because the Federal Reserve at the same time was drastically lowering rates coming out of the dot-com bust. So mortgage rates are sluggish compared to the Federal Reserve funds rate, federal funds rate. They tend to act a little slower, so they started coming off their highs. When we got into this recession, the Fed was already sharpening their drop, so did 30-year rates, right? So they're coming down. So as they came down, home prices actually lag the interest rate market because it takes so much time for somebody to go, okay, rates are getting better, they're getting better, until they find like somebody, hey, Timmy down the street bought a house, and holy cow, what rate did he get? Oh, we should do it. Because it's like, 2 or 3 months go by, 4 months, 5 months go by before you go, wait a minute, didn't somebody down there buy a house or somebody? So it's human reaction times are a lot slower. So the home prices tend to trend slower than these. So as these started, this bottom down here popped up right here to 6.34. They treaded water at 6. So you'll see right here, this correlates right behind the spike in rates, and then it sort of treads water. And then in 07, we topped for that time zone at 6 3/4. Okay, now that was too much. Now, why was it too much? The economy was reeling because everything was going up. Now, not like today, but we had gasoline going up, diesel going up, oil was going up steadily. We had some vehicle prices were going up because of this mad rush for SUVs. I don't know if you remember this. And things were just getting a little too tight. Credit was up there. Credit card debt was topping out. It was hitting some pretty gnarly highs. And we were seeing all kinds of other metrics like student debt. So very similar to what we're seeing now, but less back then. But it was all sort of converging. What happened was we started to see a stall in homes. And that stall actually happened back here. But you see right here, the prices peaked right here in 2007. Now, why is that important? They stalled here, they peaked because homes weren't selling. So eventually somebody had to start lowering their price. Well, by that time, rates were they were starting to really drop into the Great Recession. Now the Great Recession was right here. This zone right here being from 2008 to 2010. Ultimately, rates bottomed on a 30-year fixed at 5%. But you can see that homes kept making their drop. They came up a little bit, right, as rates severely dropped for that time period. But then we saw a time of even more dropping. We saw rates coming down even more right here. And we saw home prices coming down. All right, they both bottomed right here around 2012. Let's put it 2011 to 2012. All right, so now, this is where you really should have been picking up homes massively. And there's some indicators to show you where exactly, and based off the Fed funds rate, exactly when to start buying. And I go into more detail on that in my course. But let's do this. Let's dive over here. All right, so we have housing prices, the median sale price of a home bottoming between 2011 and 2012. We also see that bottom correlate pretty darn well with the employment to population ratio. And we also see it correlate with the 30-year fixed mortgage prices. So you can see when you're looking at the big picture, you're going, all right, here we go. This is my zone right here to buy, right? All right. Now, I also go into the course and talk about why it's important to buy right a little bit before, and how the refinance snowball effect is amazing. Because if you're buying any real estate in this zone right down here before, and I don't want to give away how you know it, but when you're buying real estate here and you're buying right? As long as you're always putting down your minimum down payment, this is what I like to do. This is what I did. I put the minimum down payment for a rental, and I wanted it to cash flow. And I wanted about a 10% rate of return per year initially on my initial investment, which was the down payment and the fees, right? If you buy here, as rates are coming down and you're refinancing, you'll notice that your home price starts to tick up, and you're able to pull money out and get your initial investment back, and you're able to refinance at a lower rate. It's really awesome. And either your ROI goes up or it stays the same, so you should be in the green, right? But today, in this day and age, people are putting huge down payments on rentals. Blows me away. 10, 20% just to break even. That is not a good investment in my opinion. All right, so right here, your buy zone between 2011 and 2012, you start just aggressively buying. Now, you'll notice, I just want people to know that there weren't a ton of buyers. The velocity for transactions was actually quite low and a lot of inventory was on the market. So even though you see this home price going up, it wasn't based on a ton of velocity, just like what you're seeing right now. Velocity in real estate is dead. As a matter of fact, there wasn't a lot of velocity since I've had this YouTube channel. Velocity's fallen off of a cliff compared to boom times like 2015 to 2018, things like that. So as the rate starts getting lower and lower, right? You see it coming down from, let's say, 5% to 4%. What do you see? You see the median home price go from here up to here. Really nice, really easy to correlate that. But at the same time, you're seeing employment gaining. The employment numbers are stellar. Everything's looking good. Your wages are going up really nice, median wages. Okay, now this is where we get very serious, and this is not a joke right here. Obviously, this is an anomaly. To watch employment drop off a cliff like this because everybody was forced to go home is unheard of. And you see it correct pretty darn quickly, right? But now we're seeing this top. Now, I want you to understand this is very important. And if the editor is putting up for the other channel, Real Estate Ninja channel, you'll notice these peaks are, you could put a ruler to it. This is my drawing, so it's not. But this is very important right here. This line on that chart is almost darn identical. And this goes back to technical analysis and stocks. Technical analysis and these, dot plots and all these ways, that you get the Fibonacci numbers and stuff are very real because it's a frequency, it's a human emotion. And everything history does absolutely repeat. The only reason it rhymes a little bit is because there's just little different nuances that cause the same problem. And we are topping. So we are going to see this drop, this number drop. Now, at the same time, we are seeing interest rates rise, not only this time because the Fed wants to tighten, but we have a currency collapse. We have the US currency and the BRICS. So the dollar is, it's a real tough one to explain. Well, it's really tough for people to comprehend because the US dollar has been commanding excellence because it's dominated the world's currency markets for so long. So the only thing you can compare the dollar to is a handful of other currencies that are falling in value. So they're all falling in value, and we know they are because everything's getting more expensive, right? Sometimes the dollar just looks a little better than other currencies like the euro because it's the least smelling turd in the punch bowl, if you get what I mean. And so what we're seeing now is we have a US, and I'm going to list them right here. So that's the problems. We've got a dollar crash. And this is because, and it's happening because of inflation is the proof, all right? You have the BRICS wanting to destroy the dollar. They're coming up with a whole nother currency standard and doing trade in with other countries, right? You've got a digital dollar or a CBDC, central bank digital currency. Now that is going to be implemented. How do you implement a currency during a crisis? That's a whole nother video. You've got inflation. This time, unlike the crash of 2008, you have food inflation and you have energy. So just back in 2008, the one energy form that was rising was oil, which translated to higher gas and diesel prices. But now you have all energy inflating, all right? You have commodities rising. Similar to, let's say, rare earth metals, things like that. And the reason why is because there is now a war around the world because of the BRICS splitting off from the Western worlds, right? You've got a lot of things that are completely different than now. Oh, and let me tell you this, and this is the most important that you have to understand, the election. If you take election cycles and you put them through this right here, you'll have a really awesome understanding of what happens during these rate cycles, the home price cycles, the employment cycles, and how these numbers change. Coming back here real quick, I want you to see this. This rate hike from it bottomed in 2021 at 2.75%. Look at where we are now at 7. I want to remind you, even through the Great Recession, we never saw on a percentage basis rates rise anywhere near like this. They barely did. They came up a little bit right here. During 2018, when the Fed funds rate, they were raising these rates, look at how long it took rates to go from 4 to 5%. That was, it didn't do anything, but home prices were stalling here, and it's because velocity was stalling. And that's what people need to understand. This right here is the craziest rate of rise that we've ever seen. There are people on YouTube that are telling you that they made tens of millions of dollars doing real estate and you could do it too. And all they did is they started buying here. They'd never owned a home since this point. All they've seen their entire life is the median home price rise. All they've ever seen in their entire life is the median nominal earnings rise in the country. All they've ever seen is the employment going up. Even for this brief point, whatever, they got a bunch of subscribers based off of stimulus checks. And then again, all they've seen is rates going down until just now. And I'm telling you what, even all of this time, those YouTubers have been telling you homes are always gonna go up. Homes are always gonna go up. Now you look at this chart and you'd go, you know what? Ninja, home prices from here to here, who cares about this drop? Who cares about this drop? They're higher. Well, this is because your currency has been destroyed that entire time. Nothing, you don't make. These wages right here did not keep up with the destruction of your currency, right? I want you to understand this. Millions of people lost their jobs during this time right here. Millions of people lost their homes during this time right here. Okay, it doesn't matter what your home price was from here to here. It was right from here to here. People were screaming up and down, jumping up and down, having tons of parties. I remember them like it was yesterday. And then I remember them down here when they were screaming and crying at dinner parties. They don't know where they're going to live. They don't know how, rent has increased so much. What are we going to do? We're claiming bankruptcy. This is the time where you're going to be picking up homes. The question is, what does this hold on the chart? This time period from 2023 to let's say 2030. I can't write. And that's a question that you're going to have to answer yourself. And based off of all of this information and what you think's coming, that's how you're going to prepare. You know, everybody asks me that question, how much do I need? How much do I need? And I'm like, well, that's up to you. That's up to your own convictions. Do you believe we're in a crash? Do you believe that we're going to see something really bad here? If you do, then you need to base that off of your own feelings, your own gut feelings. And the only way you can sharpen those gut feelings and those plans is by getting around people of like-mindedness that are smarter than you, quite frankly. I did not get where I was today by hanging out with people like me or dumber than me. And my mentors are vast. I have mentors everywhere, and I'm constantly finding new ones, and I want to stretch myself. And that's what you need to be doing right now, because I want you to understand this right here is nothing compared to what's going to happen here. If you look at what's just happened with the banks as they're collapsing, this is going to be insane. And if you think this country's run crazy right now, wait till people start losing their minds and they're losing their homes. That's going to be really crazy. Hey, I'm going to put that link down below. The 80% off will never happen again after Sunday. I'm just giving everybody on the channel ample warning because I know that there's going to be some wild times ahead, and I just don't want people coming and going, hey, you know, I still want it. So I'm listening to my mentors and raising the price. And just so you guys know, I'm putting a ton more information in that course starting next month into the first of the year, especially as we start seeing the foreclosure market start to turn. All right, with that being said, I thank you so much for watching. The Economic Ninja is out.